Hello, everybody, and welcome to the Tortoise channel. Today, we are analyzing TeamViewer SE, and this is because one of our recent Skool community members, Felipe Pina, also a fellow Portuguese, has asked me to analyze this company. I have to confess, so full transparency, I don't have any investments in the company. In fact, I had never analyzed it before. This will be my first time going through the financials of the company here with you all. And so I'm not sure if this company has been on your radar, but if so, hopefully you will be able to get a lot of value from this video. And if that is the case, please make sure you smash the like button and share this with people that, in your opinion, might benefit from what we are trying to build right here. And so without further ado, let's just hop right into it. You can see that this company, in fact, if I go here to general, look at that. I mean, 2000 from a peak of 2000 in 2020 and 2021, a peak of about 26 in the 25, 20, and $26 respectively, right? $26 per share. This company crashed all the way down to about $3 per share. Again, this happened with many software companies after COVID. They just crushed. Maybe it was one of the darlings at one of the stay-at-home stock companies that everybody was invested in. But then after COVID, people just stopped buying their products or services. Maybe that was the case. I don't know, Felipe. But make sure that you understand exactly what's happening here. And in fact, for all of you guys that are watching this, one of the things that you can do, for example, I can perfectly come here to Google Gemini and I can type in stock viewer SE stock, and I can ask this. I can say, so I can ask Google Gemini, why has this stock crashed? Okay, and what happens is it will list out all the main reasons for the stock being currently under pressure. Okay, don't take any of what you read right here for granted. It's important to do your own due diligence as well. But this is very, very cool. And I can tell you that many of them are accurate from personal experience. All right. So with other companies. So you can see that the multiple has come down sharply on the back of slower growth forecasts. Okay, that's understandable. So the growth rates have tumbled, and so in the multiple followed. Okay, but another key reason that they are pointing out here is that largely that the pressure has been largely derived from difficulties with its acquired money business and broader economic challenges. So apparently they did acquisitions, and those acquisitions haven't bode well for the company. So they have been facing issues integrating that company with business segments that they have. So that may be one of the reasons why the stock has come under pressure. Let's have a look. The TeamViewer has faced significant issues integrating this business, digital monitoring businesses. These issues have included a loss of senior salespeople and customers, integrating issues, particularly in the US government market, which has negatively impacted sales performance and, by extension, TeamViewer's overall growth. This can be a big deal. And again, it's important for us to understand, has this been their first acquisition, or has the company done other acquisitions? And how well have those acquisitions worked out? Has the company managed to actually improve its fundamentals, or they just embarked on an acquisition spree to improve top line growth to the detriment of all the other metrics? This is very, very important for us to keep an eye on as long-term shareholders. All right. But let's then jump right into the fundamentals right here. And you can see how what the company is. Look, TeamViewer, together with subsidiaries, provides remote connectivity solutions worldwide. The company offers TeamViewer remote access control and management solutions. Okay, digital workflow instruction. Okay, so an important thing to point out is that what we are doing right here in these videos, when I just give you, for example, a detailed a detailed breakdown of the company's fundamentals from a financial standpoint, what's important to understand is that that is just a piece of the puzzle. Remember our approach, our entire framework. Okay, if I show you right here, you can see that meaning is the first one. Okay, then we have the mode, management, and margin of safety. There is only so much that I can cover in a YouTube video. So I can discuss the numbers, and I will be able to see in the numbers whether the company has a moat or not, because if it does, the numbers will show me that. Okay, I will have that consistency and predictability in the numbers that I'm aiming for. But ultimately, you have to understand how the company makes money. So, do you understand the business model? Do they understand the geographic split? Do you understand the management team? Okay, do they have skin in the game? So there are a lot of moving parts. But like I said, in videos like this, in this video, I'm only going through the financials of the business, okay, and tell you what I think, among other stuff, of course. So let's continue. And if I can see that Stock and Lock gives it a 4.11 score out of 5, which is quite good. If I go here to Insights, I can see that they score very high on profitability and management. I like that. Growth is being average overall. The financial health is the problem, and I can almost guarantee this is because of acquisitions. I can almost guarantee they had to take on that to fund those acquisitions. I don't really like that, but we will talk about that. Okay, as long as it's not something that can greatly impact the business structure, right, or the business performance going forward, then it's okay. But it may be a red flag. Okay, so analysts seem to be constructive, and valuation seems to be favorable as well. Let's go to financials, starting with income statement, and let's have a look at the company's track record. So, by the way, they have been operating. They IPO'd in 2019, so we don't have our 10 years of data as we would normally prefer, but that's okay because that's we still have many years of financial data. Okay, and so let's go here to financials, total revenue, and you can see that total revenues have been going up since 2018. In fact, they have compounded by about 17.25%. However, that growth has slowed down sharply. Okay, since 2021, as you can see, that growth has only been up. As only the company has only compounded revenues at about 10% per year. And if I show you the trailing 12 months, you can see that revenue still continue to go up, but it's slowing down. Okay, but still, this is very, very good growth as well. But nothing like a hyper growth company as this company was once priced at. Okay, so definitely I can see the growth numbers have come down substantially, and so did the multiple. Let's have a look at the operating income. Okay, so the income, the earnings the company generates from its operations. And you can see that since 2021, this has been going up by about 21% per year, which is very good. But look what happened since 2020. Okay, so the growth rate, it reached a peak right here. The operating income reached a peak in 2020. Then after COVID, it just plummeted. But since then, it seems to be on the way up. Okay, but again, this only goes to about 2020, 2021. But it's still very solid growth, however. And earnings, it will probably be the same. This is what I don't like to see. Look at that. The earnings have come down. They have been coming under pressure since the peak in 2025. Look at that on a trailing 12 month basis. Okay, but still since 2021, this thing has been compounding by about 23%. Let's zoom out here. Yeah, look at that. Look, so it was up in 2019, 2020, and then it just crashed in 2021, which significantly, of course, affected the growth rate. But so you only since 2019 has the company really been trending upwards. Okay, but again, notice the slowdown right here. So something to keep an eye out on. I don't really like to see that because you can see that since 2029, earnings have only grown by about 3.4% per year. I don't really like that. Okay, so this is already a bit red flag, Felipe. And what makes you think that the earnings are going to continue to move in the right direction since 2021? Because clearly we only have a few years of data here. Okay, since 2021. I mean, I don't have that long-term horizon. Okay, so understand that. Diluted shares outstanding. This is definitely good. In fact, since 2029, look at that. Shares outstanding have been reduced by about 20%. So these guys are buying back stock. Do they think the stock is cheap? Maybe they do, which is why they are doing a lot of buybacks. But most importantly, notice that we looked at that Stock and Lock flagged the financial health of the company. They flagged that, and they gave it a very low score. Are they funding those buybacks through debt? Something we have to analyze as well. Okay, so when we see diluted shares outstanding going down, that is awesome. But then we have to scratch, and that we are just scratching the surface, right? We have to understand if those buybacks are being performed with the company's free cash flow, right, or if they are using debt to do such thing. In which case, that would be a red flag. Let's have a look at the margins. Look at that. Gross margin since 2019 has remained pretty flat, very good. I love seeing that consistency in the gross margin. Okay, about 86.58%. But then again, these businesses are very light. They are not capital intensive, right? So they have a very light model. And so it makes sense for the gross margin to be very high. What about operating margin? This is where some of the problems already lie. You can see that it was at 39%, 36%, then it dumped to 23%. Now it seems to be going up again, which is very good, but again, only since 2021. Yeah, will this continue or not? But I like to see this happening because it's not operating margins for this to be expanding. It means that the business is achieving operating leverage, so management can control the operating costs of the business. All right, and so because revenues are not growing as fast as they used to, maybe they are doing a lot more cost control, which allows the margin to be expanding as well. The key here is this happening against the backdrop of lower investments towards R&D? And if that is the case, it can be a red flag. So understand why this is happening as well. Net margin, let's have a look. Look at that. 2019, 2020, it just plummeted as well. Now it seems to be going up again. But since 2023 and 2024, it's remained pretty flat. Let's zoom in. Yeah, it's coming down exactly because net income has also come under pressure, as we saw. Okay, so for a software company, I don't think this is great margins. I would love to see operating margins and net margins at higher levels than they actually are. All right, let's have a look at the balance sheet. Let's go right to book value. Oh man, don't like to see that. This is a software company. To book value, for those of you who don't know, total assets minus liabilities. Ideally, I would like to see book value going up over time. It's going down since 2021, and only recently as this started upticking. Let's change this to the quarterly if I can. Yeah, so it's just going up, but not good. I just don't like to see that. And I guess that's probably because of that. But let's look at it let's look at it closer. If I go to financials, trailing 12 months, let's go here to the balance sheet. Oh, actually, let's go to statistics. This is the problem. Look at that. Cash and cash equivalents, about 43 million. Total debt, 1.17 billion. So, of course, they have a significant negative net cash position. Yeah, look at that. Not very good, is it? and that explains the depressed book value. They have a lot of debt. What's more, look at that. What's the reason why I don't like this is because this will impact the financial position of the company. I like to see, for example, the debt to EBITDA under 3. We have above 3. Debt to equity, I like to see this under 3 as well. And here we have a very leveraged balance sheet. Okay, and then you have the debt to free cash flow that is 4.49. What does that mean, guys? It means how many years will it take the company to pay down all of its debt from current free cash flows? And you can see that in their case, it will take them about 4.5 years to cover all of their debt. Now, look, I like to see this number under 3, but there are many reasons why free cash flow might be depressed as well. They may be doing buybacks, in which case that would be a positive. Okay, so let's have a look at debt to net income. And for that, let's go here to financials, trailing 12 months. Let's take net income right here, 115, 115. And now let's take a look at the total that the company has. And that is about 9. Let's do the math right here. 115 divided by 997. Okay, so you can see that the company has a lot more. The company has a lot. What is that? 115. And what's the free cash flow of the company? Let's have a look. So the free cash flow is about 222. Free cash flow is about 222, and 222, and that's what did I do wrong? Oh, I know what I did wrong. Sorry. Okay, so let's go to the balance sheet again. We have to take total debt first. Let's take total debt, which we already know. So yeah, it's 997. Yeah, now let's divide 997 by 115. And here we go. This is the problem. Okay, I don't like that. To me, this is already a big red flag. What this means is that so we are taking the total debt and we are dividing the total debt by the current net income. And what you have is 8.7 years. What this means is that it would take the company almost 9 years to pay down all of its debt from current earnings. I don't like that. To give you some to give you some context, I buy companies. Every company in my portfolio would be able to pay down all of the debt within 3 years of current earnings. Okay, so it goes to show how bad this is into my eyes. All right, so to me, this is already reason for me to say no to this business. Is very leveraged. I just don't like the balance sheet, and I understand why stock unlock gives the financial health of the company a big red. Okay. In addition, look at the current ratio. When you do current assets minus current liabilities, ideally you want to see this above 1 and to be perfect above 2. Look at that. Okay. So the business would have trouble covering its current liabilities from current assets. Not good. Okay. Not good. I don't like to see that. But let's continue. Let's now go to the cash flow. This is the cash flow from operations. And if I flip this to the yearly, look at that again. Since 2021, seems to be things seem to be moving up, but since 2018, look at that. Then we had this jump. But yeah, so the business generates cash from its operations, which I like to see. Let's have a look at stock-based compensation, which is also important. Let's see. So if I go to cash flows and stock-based compensation, I love seeing the fact that now with the business struggling, okay, and the stock significantly down, I love seeing the fact that stock-based compensation has been going down. I like that. Okay, I really like to see that. To me, this is a big positive. What about debt repayments? Okay, so they've been repaying some of their debt, but What are they doing? Net common stock issued. Now I want to see investments. Okay, they were doing a lot of investments in 2020, but now recently they are not doing that many investments. Okay, so what are they doing with the cash flow then? We have to understand that. Pa, pa, pa. Buybacks, where is that? Buybacks, net common stock issued. Let's have a look here. Repurchase of common stock. Let's change this to the annual. So we discussed free cash flows. Well, not yet, but we will do so. Let me see. Yes, so they are not doing inf- they were doing a lot of reinvestments. Certainly here in capex was really high in 2020, but this thing has been coming down. Why? Yeah, shouldn't it be the other way around? Because they are facing competition. They have to keep themselves at the front of the curve here. So I can see that this is how much operating cash flow the business is generating, and I can see their repurchases of common stock. They were up in 2022, but it's been coming down. And the financing, look at the financing cash flows. Okay, it's gone up as well. This is because they took on debt, and now and the free cash flows, of course, is about 222. Um, I don't re- I don't really like this. I don't like this financial statement. Um, I don't like it. I see too many red flags. Um, the free cash flows have been going up since 2021 as well, trailing 12 months. They are now coming down, and I can see, look at the they are using a lot of those cash flows to pay down debt, even though they are not paying as much debt, but they are also using that to buybacks. So a lot of the cash is being used towards buybacks. You can see that free cash flow is about 243, and the debt repayments 97, plus net common stock issued about 137. What about reinvestment into growth? Okay, because this is a software company, so wouldn't it make sense for them to be reinvesting more in growth? This is a question that you have to answer. So if this is a company that you might be interested in, try to understand why that is. What kind of reinvestments are they making? So for example, if I go here to research and development, I can see that it's been going up since 2021 as well. But capex, right, investments in property, plant, and equipment is actually going down. Now, this is a software company, granted, but um, what about the AI infrastructure? Maybe, I mean, are they not integrating AI into their business operations? Understand why this has come down, okay? Look, the key thing here is that I don't really like this. I don't like the balance sheet. I don't like the growth rates over, and I don't like the consistency in the numbers as well. And if I go here to insiders, I can see that okay, so insiders have been buying the company. That's good. We like to see that. Look at that, a lot of buying. Wait, so let's have a look at ownership. Show only account, only company executives. So the chairman has about 15 million dollars worth of stock, but there are a lot of people in the company that are doing a lot of buying. Look at that, and this is exactly what you want to see. Okay. That said, and I can see that analysts are very constructive on the company as well. They don't pay dividends, of course. They are still in a growth stage. Look, this to me is a hard pass. I don't like the balance sheet. I don't know whether this company will have in fact, I just don't like how levered the balance sheet looks, and I think if the company continues to face more competition, or if interest rates, for example, were to increase, and if the interest payments on the debt were to increase as well, this company would struggle. This company would struggle because they currently they have a lot of debt relative to how much cash they have. So it's definitely a pass for me. Okay, and I can see that the PE, for example, is about 8 times. But like I said, price is what you pay, value is what you get. And this yield here, right here, in this earnings yield, I like quality. Quality is more important than valuation. I want you guys to understand that. Yes, I put a lot of emphasis on valuation, but only after quality has been vetted carefully. Okay, I need to like the business from a quality standpoint. Only then valuation becomes more important. So to me, this doesn't mean anything because it's a business whose quality I just don't like. But look, let me know in the comments if you've managed to find this video insightful. That's just my perspective. Again, consider the other M's of the framework. In Felipe, I hope you managed to gain value from today's video. If so, let me know in the comments below. And you guys, if there are any other companies you'd like me to analyze, just let me know in the comments as well. And stay tuned for more.